Alright, hey, what's up guys? Scott here again with my next live trading video, and for this one I'll be showing you guys, in my view, the best way to manage a wheel strategy position based on the current state of that trade, right? So for example, in this account here, I've got, I believe, 6 different experimental wheel strategy trades, some of which are doing quite well, a few others are kind of so-so, and a few of those trades are not doing well at all. So of course, based on the state of those trades, they're going to require a different kind of management. And so now with the expiration dates for each one of these trades coming pretty close at this point, I believe they're all in the August monthly cycle, which is expires next Friday. That's why, again, in this video, I'm going to walk through each trade here and show you in detail how I'm going to manage each one of them. Now, briefly here before diving in, make sure you guys watch until the end of the video, because at that point, I've got a very cool opportunity where you can receive up to 10 free stocks. And then also, if you would like to join a very exclusive online community where you can learn how to successfully trade options, then you can now join my options trading Discord. So definitely make sure to check out the description of this video below to learn a lot more about that. And then finally, for anybody who is also brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and as you can see down below in this category, these are the 6 experimental wheel strategy positions I have on in this account right now. So like I said, we'll just walk through each one here, and I'll show you how I'm going to manage each one of them based on their current status. So first up in AA or Alcoa, as you can see, I'm short 2 contracts right now, 2 put options specifically, with a 75 strike. Right, so currently with AA, I'm still in the first phase of the wheel strategy trade, where basically I'm short some put options and I have not yet taken assignment on those puts to then sell cover calls. And the reason for that is, if I come to the trade tab real quick now, and we'll go to AA, and then for this trade, as you can see, I'm in the August 19th monthly expiration, only now with 10 days, so that's why I'm managing these trades now, and I'll unfold this tab here. And then if I scroll all the way down, as you can see right here, these are my current put options, which are way in the money still. Right, so basically, if we quickly come to the chart so you can just visually see what happened with this trade, I believe it was around this point where I placed that initial position of selling 2 put option contracts with that 75 strike, right? Because ultimately I was hoping that after this huge breakdown candle, Alcoa here would at some point start to recover and perhaps resume to maybe new highs. But unfortunately, the exact opposite played out, and the stock just continued to go lower and lower and lower. Although in very recent times, the stock has recovered at least a little bit. And so bottom line here, I personally don't like to take assignment on these put options for the wheel strategy if the stock is nowhere near my cost basis on the trade. Right, so for Alcoa here, because the stock just kept going lower and lower and lower by huge amounts pretty much every week and every month, I was never in a position to take assignment on this trade that was anywhere close to my cost basis with this stock. And so that's why here, all through this time, every time expiration got close, I simply rolled out the put option to the next cycle and tried to collect more credit and possibly reduce my strikes as well, if possible, to basically follow the stock lower and keep my risk from getting too large. But unfortunately, this only really works if your put options are not too far in the money, right? Because once that happens, basically if the delta on the put options, as you'll see here in a moment, if the delta becomes 1, in which case the option is trading just like stock at this point, you're not going to be able to roll the contract anymore for additional credit. Right, so for example, if we come back to the monitor tab real quick and I try to create a trade to roll out these contracts from the August cycle to the September cycle, let's see what happens here. I'm going to right click and then go to create rolling order and sell 2 calendar spreads. And then down below here is the order. As you can see, in just one trade, I'm going to buy back my existing August put option contracts, 2 of them, and then sell 2 more in the September cycle, which is September 16th. And so here we go. This is exactly what I'm talking about. So because my put options here are so far in the money, and because the delta on these options is basically 1, that means there is no more extrinsic value in these contracts. And therefore, these options are trading just like long stock. And bottom line, that is the reason why I can't roll these contracts anymore for additional premium. And in fact, because the bid-ask spreads here are so wide, I actually have to pay a small debit to roll these contracts. However, here, because earlier on in this trade, I was able to roll these contracts for additional premium, that did help somewhat and reduce my cost basis on this trade further. So basically at this point, my break-even point on this trade, if I did get assigned on the stock, would be somewhere around 69 bucks per share, which unfortunately is still a long ways away from the current stock price of Alcoa here. So ultimately here, because my put options in this case are trading now just like 100 shares of long stock per contract, and that's why again I can't roll them for any more additional premium. At this point, I may as well just hold these contracts to expiration and finally just take assignment, right? Because in really bad situations like this, taking assignment does not add any more risk to the trade. And that's again because the deltas on my contracts here are already 100. They are literally trading just like stock. So if Alcoa goes lower from here, the losses on the put options would be the exact same as losses on 100 shares of stock. However, if the stock does recover from this point, then with shares of stock, I'm going to make a lot more money back because with the stock, that position will never change. I'm going to be long, in this case, 200 shares for my two contracts here. And so therefore, with every dollar the stock climbs back, I'm going to make 200 bucks. But if I still went ahead and rolled these contracts to the next cycle in September and just kept these put options going, then again, if Alcoa here recovers, then the deltas on these contracts are going to slowly decrease and therefore behave like a smaller and smaller stock position. And of course, that has the effect of making money back still, but at a much slower pace than again, just having a full stock position after assignment. So bottom line here for this trade, I've done everything I can at this point. I've rolled the contracts out multiple times, collected more credit along the way, but now with these contracts just so far in the money, there's not much else I can do except take assignment and just hope for the best. And also, in case you're wondering, in this case as well, I can't really sell covered call options either after I take assignment, right? Because to do so with strikes at or around my cost basis on this trade, I have to pick strikes at around 69 or 70 bucks. So if we go into the September cycle real quick, unfold this tab here and scroll down. And right here, for example, is the 70 strike call options, which are only trading for a price of around 10 bucks or so. The bid-ask spread here is pretty wide, but still almost $0. So perhaps maybe I will still sell these anyway just to collect a few extra bucks, but really it's not worth it. And so that is my Alcoa position. Just going to leave it as is for the time being and wait for expiration to come. So we'll come back to the monitor tab and go to the next one here. In which case, this one is my Apple wheel strategy position. So for this trade, as you can see, I'm short one contract, 140 strike put option with the same August 19th expiration cycle. Now for this trade, unlike AA, this one is doing very well because if we, for example, come to the charts and go to Apple real quick, this stock has done nothing in recent times but just goes straight up. So of course, as you might expect, if we come to the trade tab real quick and then back to the August expiration cycle, my put option here is well out of the money. And in fact, it's almost trading for $0. And actually here, even though there's a very good chance that this put option will expire worthless in only 10 more days, I'm still going to go ahead and close the position and just remove my risk here on the trade. So I'm going to buy back this put option for about $5 or $6. And down below here is the order. I'll lock in a price of exactly $6 and we'll see what happens here. And there we go, just got filled at exactly 6. Awesome. And then of course, now at this point, I technically can come to the September cycle and sell a brand new put option with a higher strike, obviously. But once again, like I showed you on the chart here, because Apple is just so sky high at the moment, I do prefer at this point to wait a little bit for the stock to potentially come down a bit lower. Maybe right here to the 200 period moving average, but bottom line, at these prices, I don't yet want to sell a brand new put option. And so that's Apple. Next up, we'll come back to the monitor tab and take a look at my FCX position. So this company here is Freeport-McMoRan Incorporated, and they're basically involved in the mining of things like copper and other forms of materials. And so for this trade, I'm short 2 put option contracts with a 46 strike, same expiration. And just like Alcoa here, this one is in pretty bad shape as well. Right, so back to the charts, we'll take a look at FCX. And then, yeah, same story here. The stock has done nothing but go straight down in the recent few months here. And right now the stock is trading at around 30 bucks per share. And again, keep in mind, my put option strikes are all the way up here at 46. And so, as I'm sure you can imagine, for this trade, I'm going to manage it in the exact same way as for Alcoa here. Right, so once again here, my put options are super far in the money. Delta is basically 100, so at this point, I can't roll these contracts out anymore for additional premium, so I may as well take assignment and hope for the best. And also here, I do want to mention for these kinds of situations as well, how important it is to always use the wheel strategy on stocks that have quality fundamentals, right? So for example, FCX here is a profitable company and is likely to recover at some point in the future. And then also, of course, most importantly, to keep your risk per trade very, very small. Right, so for example, you should not be allocating maybe 20 or 30% of your account for one wheel strategy position. That's just way too much risk, because if this kind of thing does play out, you're going to lose a huge portion of your portfolio. But for my FCX position here, the entire capital requirements to hold these put options and eventually to take assignment on 200 shares of stock, those capital requirements are only about 3.5% of the entire account value in this case. So even in the worst possible scenario where FCX goes bankrupt and the stock goes to zero, even in that situation, I'm going to lose only 3.5% of my account, not 20%, 30%, or even more. So again here, always keep your risk very small per trade, ideally under 5% of your account, maybe a max of 10% if you have a smaller account. And even doing just that by itself, just keeping your risk small, will allow you to survive some of the worst bear market environments and some of the craziest market events. And so that's FCX. Now back to the monitor tab and on to the next one here, which is Netflix. And so for this one here, I'm short the 180 strike put option, same expiration cycle. And finally, this entire position is now profitable. So coming back to the trade tab now, and we'll go to Netflix real quick. And so basically here, after rolling this put option, I think 3 times at this point to the next expiration cycle, it is finally going to expire worthless. And originally for this trade, I was short the 200 strike put option, not the 180 here. So basically each time I rolled the contract, because the implied volatility was so high and because this option was never too far in the money, I was always able to roll the contract and reduce my strike while still collecting more additional premium. So my initial credit for this trade was about $665, I believe. But now at this point, after so many rolls, my total credit at this point is about $1,300. So finally, with this put option expiring worthless, that's going to be my final profit here on this trade, about $1,300. And just like for my Apple trade here, because this put option is almost at a near zero price, I'm just going to go ahead and buy it back now to remove my risk on the position. So I'll click on the asking price here, and I'll buy back this put option for a debit of about $10. That's it. So we'll go to confirm and send the order. And there we go, just got filled at exactly 10. Awesome. And also here, similar to Apple, if we come to the charts for Netflix, as you can see, I'll zoom in a little bit on this chart. Netflix has also been on a pretty huge tear to the upside. So once more, I'm just going to wait for a little bit, see if the stock can come down. And at that point, I'll sell a brand new put option. So that's Netflix. Let's come back to the monitor tab and 2 more to go. One is in NUE here. And as you can see, I'm short the 145 strike put option. Again, same August expiration. Let's check that trade out. Go to the trade tab and we'll go to NUE. And for this trade here, my put option is still in the money, but it's not too far in the money, right? So the delta here is 80, not the full 100. So I could roll this contract to September and collect more additional premium, but I've already done so multiple times at this point, right? I believe originally this trade was in the May expiration cycle a few months ago. And now my total collected credit on this trade is about $1,200. So that means my break-even point, or my cost basis on this trade, is all the way down here at around $133 per share, right? Because $1,200 in total premium divided by 100, which is 12, and then 145 minus 12 is 133. So like I said earlier, if the stock by expiration is somewhere near your cost basis, then I don't see any reason why you shouldn't take assignment and then flip to selling covered calls, right? Because bottom line, if you do take assignment around your cost basis, then you'll be able to sell those covered calls for decent premium. Otherwise, in the case of Alcoa or FCX, if the shares are just so much far below your cost basis, those covered calls are going to be worth almost no money. So finally for this trade, I no longer have to roll these put options anymore. So I'm going to plan at least on taking assignment by the expiration date in 10 days unless of course by that point Nucor has a massive downside move, in which case again at that point I might have to once more roll these put options to September. And then finally here, back to the monitor tab one last time, and I've got one more position down below in XOP, and this one's a bit different because I've already gone ahead and taken assignment on 100 shares of this ETF and then sold a covered call option. So specifically, as you can see, I'm short the 134 strike call, and right now if we go back to the trade tab and go to XOP and then scroll down a little bit, as you can see my covered call is still out of the money and will likely expire worthless. However, unlike Apple and Netflix, this option is still trading for a much higher price than near zero. So for this one, I'm not going to do anything with this trade, just going to leave it alone, and hopefully in the next 10 days it expires worthless, or I can perhaps buy it back for a near zero price. And then of course at that point, I can come down below to the September cycle and sell a brand new covered call. And I believe my cost basis on this trade is all the way down to about 110 bucks per share. So even if XOP has a massive fall between now and that time, or any time in the near future, I can still sell covered calls way below the current stock price. So ultimately, I do expect this trade here to continue doing pretty well for quite some time. And so there you go. That's how I personally manage wheel strategy positions. So hopefully you found this video insightful and perhaps gave you some ideas as to how you can manage your trades as well. And so with that being said, that's going to do it here for this video. But of course, one last thing, I've got a very cool opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord, as well as my SKILLSHARE courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.